Firstly, the Bank of England's economic update, which was published just last week, their MPC decided to keep interest rates at 0.1%, which wasn't a major surprise to anyone in all honesty. The good news for borrowers is also bad news for savers. And the bank said that they expect the UK economy to recover to pre-COVID levels before the end of this year, which is awesome. The bank also released the money and credit statistics. I personally find this much more informative than the general interest rate because it talks a lot about things like the velocity of money, the availability of credit, and these are key metrics for the economy, even more so now that we head into this post-pandemic phase of our recovery. The velocity of money is about the number of times that a single pound moves from customer to business to its employees and staff to other businesses and to the government in tax revenue that they collect along that process. Whereas credit is the availability and the amount of borrowing, the interest rate that is charged on this borrowing, as well as the deposits that households and businesses put in the bank and that this borrowing is secured against. So the figures from the Bank of England show that households saved 16.2 billion in their bank accounts, and that's just in March. They did this really as the average savings rate dropped to 0.1%. Woohoo! The low interest rate on savings, though, means that more people are paying back debt, and the net debt repayment was 0.5 billion that was paid back in March by borrowers. The effective rate on new loans is dropped to 5.03% compared to 7.02% that it was in January 2020. In the mortgage market, the net borrowing was about 11.8 billion in March, which is lower than the peak it was in November 2020, but still higher than the pre-credit crisis peak of 10.4 billion, and that was in October 2006. The effective rate on new loans drawn down for mortgages is 1.95%, which is up from 1.85% that it was, and in the previous month, and in August it was 1.75%. The effective rate is what people pay as opposed to what's advertised. And there's no doubt that some of this new borrowing was really driven by the stamp duty end that was expected at the end of May, but never happened, as we all know. The enthusiasm from buyers wasn't necessarily matched by the same level of enthusiasm from sellers. This meant that there was an over demand compared to the amount of supply in the market. The excess of buyers versus sellers is really at an all-time high, the highest seen in the past 10 years, in fact. And the number of buyers inquiring about each property on Rightmove is up 34%. Wow. The average stock per agent on Rightmove has fallen to the lowest level it was since July last year, which was really when we were coming out of the recession and the first lockdown, if you remember. The question everyone's really asking is, does this undersupply and overdemand really point to another housing bubble? Watch this space and time will tell.